Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 216, How to Lower Your Taxes. Cory, thank you for joining me back on another episode of Upticks.
Thanks for having me.
This looks a little bit different probably to our audience for those that are watching on YouTube, but I actually wanted to talk a little bit about something that a new initiative that you and I have been working on, and that's intentional days on Wednesdays. Do you want to talk a little bit about what that looks like?
Sure, absolutely. You ready to get right into it?
Go ahead. What are you doing on Wednesdays?
Yeah, so what I've been doing on Wednesdays is, working out of the office. I'm at home in my office right now, and structuring out the day to work on the activities that are to put it simply, outside of just meeting with clients. So being intentional with those days to keep the week structured appropriately and to ultimately allow for all of our time and energy to be dedicated to, meeting with and talking with clients 4 out of the 5 days every week.
Right. That's good. And I want you to guess here. So I had our financial planning group count up how many review meetings I have had year to date. So again, we're just entering the fourth quarter here, but can you guess how many reviews with clients that I've had?
Yes, give me just a moment to think this through. We are in the beginning of the fourth quarter. 200.
I've had 300 review meetings with clients. And I would argue that yours is probably pretty close. I know you don't, I have 400 clients, you have 300 clients, so you're probably a little less. But I've had 300 client review meetings. I've had over 80 client callbacks, where those are just callbacks. And I think I've had around 70 new meetings with new potential clients year to date. And you're right. So instead of you and I jumping from meeting to meeting and getting distracted by other distractions, frankly, what we're doing now is on Wednesdays, we're recording, our podcast, being very intentional about some of the things that we want to do for our company to make it better for our clients, to make it better for our team. So that on Mondays, Tuesdays, Thursdays, and Fridays, we are in full wealth advisor meeting mode, right? So the goal is to continue the volume of meetings that we've been having with clients, but we don't have to worry about squeezing other things in between those meetings. So it's called time blocking. We're real excited about it. So again, if you're watching Upticks, that's why you see me. I'm in my home office here. I've got the trash guy or somebody behind me in the window. Cory, your backdrop's a little bit cooler than mine, but hey, this is where Rachel lets me work. So this is what I do.
Well, we're fortunate that the old house that we live in had these built-in shelves behind it.
There you go. And they look good. You've done a good job with that. You got I see some wedding pictures up there and
family pictures.
Looks good. So
Cassie deserves the credit for the backdrop.
Okay, good. Good. But for today's topic, we think it's very timely because as we enter in the fourth quarter, now is the time to look at your tax situation, and you can look at things on or ways to lower your taxes, which I haven't met a client that wants to pay more in taxes. And so again, one of the things that we do at Falcon Wealth Advisors that we take it very seriously is we do tax planning for our clients. And so the first category that I wanted to talk about on ways to lower your taxes is to be cognizant of where you're pulling from if you are pulling an income stream from your assets. And so this goes typically for the retiree, or some pre-retirees are pulling from their accounts as well. But to speak about it broadly, Cory, I won't go too deep here because I want you to chime in on this. But if you look at it this way, most clients will have a brokerage account, a checking account, savings account, something that they pay taxes on every year based on interest that the bank pays them or capital gains that we make our clients. Many of our clients have IRAs, which is pre-tax money, and that money is taxed when they pull it out. And then some of our clients have Roth IRAs, which when they pull from that account, it's tax-free. And the point is, all three of those are taxed differently. And so you can really pinpoint your taxable income if you just decide where you're going to pull from. But do you have any comments on this, on situations that you've seen in the real world where clients have been able to take advantage of this?
Yes, a perfect example of what you're talking about is I've worked with clients before that we have mapped out where their income streams are going to come from specifically for tax purposes. But I've worked with clients where we have pulled money from taxable accounts in very specific calendar years in retirement to keep their taxable income lower. So either one, not all of their Social Security benefits are taxed, or two, it doesn't increase the premiums associated with Medicare.
Good point. Yeah, so we can certainly juggle that for you. And so you just want to be cognizant of that. And now some clients have what's called a required minimum distribution, and that's if you're 72 years of age or older. It's tough to get around that. But if you're younger than that, you can, and you have a few different accounts to pull from, or if you have enough money in your savings, right? Maybe you stop your distributions from your IRA in October, November, December to keep that taxable income a little bit lower this year. So again, that's definitely something that I would highly encourage all of our clients to take a look at. And certainly if you don't want to go at it alone, give us a call. Our financial planning group, Matthew, Joe, Jake, and Tyler, they really take those meetings when it comes to tax planning. And so again, I would encourage you to set up a time to meet, certainly with Joe, Jake, and Matthew. I know that they're doing those meetings more. Tyler is kind of the contact to get something scheduled. But again, set up a time. Let's take a look at how much you've pulled from your IRA or how much capital gains you've realized this year. And let's really manage that over the last 3 months. And if we can do some things to keep that income lower, that might just end up helping you tax-wise. Now, full disclosure, my compliance department is going to want this. Again, we're not tax advisors. We're not claiming to be your tax advisor. What we're doing though is tax planning. So again, you always want to run everything by your tax professional. But to us, it's pretty obvious. If you know you're going to pay taxes on an IRA distribution and you've got $30,000 in your checking account, maybe you can cut your IRA distributions for a couple months, spend down some of that checking account so that you keep your income lower for this year. So again, distributions of assets, withdrawals, whatever you want to call it, that's definitely something to take a look at here in the fourth quarter to make sure that you're not pulling out too much unnecessarily.
Yep. And I think just to add real quick to that too, Jake, thinking about future years also, and from a tax planning standpoint for clients is I guess the point that I really want to make is, just because it might make sense to do that this year, Jake, it might make sense to do something differently next year. But it's something that should be reevaluated on an annual basis.
Yeah, really good point, Cory. So again, tax planning is part of what we do, and we want to review that with every client every year, right? So it's just another meeting with our financial planning group. They're going to go over your prior year's tax returns. They're going to take a look at your current tax situation or projected taxes for this year and see what we can do to lower that bill. Very good. All right. So the next topic I wanted to bring up, which is a little bit more hypothetical or theoretical, is that asset location. And Cory, I don't know if you've studied this much, but basically what the concept is you could put certain different types of investments in different types of accounts so that your taxable liability is potentially lower. And so one concept of this is some would argue to put stocks in a brokerage account because if you hold a stock for over a year before you sell it, you're subject to capital gains taxes, and those can be anywhere from 0 to 20%, where ordinary income taxes can go up to 30% plus. And so some people would say buy stocks in a brokerage and sell it after a year, you pay capital gains, but that's much lower than putting it in an IRA and letting it grow and then pulling it out at your ordinary income. But do you have any thoughts on asset location? I know we do this for clients, but you can get a little bit too hypothetical. But do you have any thoughts or general, and again, this show isn't advice, but any just kind of general observations on asset location?
Yes, I think I might be pointing out the obvious here, Jake, but in a Roth account, owning stocks or equities, obviously with the most growth potential, because the gains, the amount of money that you make on that account is tax-free. When those distributions come out, you don't have to pay income tax. So exactly to your point about owning stocks in a brokerage account and how that may or may not make sense for someone's specific situation. The Roth account, just conversely, oftentimes it doesn't really make sense to own bonds inside of a Roth IRA because the money's growing tax-free.
I read that once, believe it or not, that someone was recommending bonds in a Roth IRA because taxable bonds in a Roth IRA, which we don't typically do, with the ideas that if you own them in a brokerage, you're going to pay taxes on that interest. And I guess in an IRA, you're going to pay it on the withdrawal regardless. But have you ever read anything like that? And again, and to me, I agree. Like if you got money in a Roth, right? You put money in a Roth after tax, so money you've already paid taxes on. But when you pull from a Roth, you don't pay any taxes. So to us, it's common sense. You want the most growth. Like you want to triple that Roth IRA. And typically bonds don't keep up with stocks as far as a long-term investment growth-wise. So have you ever thought about putting a bond in a Roth? I know we normally don't, but have you ever come across anything? And I know you read a lot too and research things, but have you ever seen that?
No, I have not. I do think, though, in the interest rate environment that we are in now, with the rates being meaningfully higher than they were 1, 3, 5 years ago, it could make more sense.
Yeah, so you're right. Good point. So if we can get a bond paying 6 or 7%, maybe that'll make sense now. But certainly, you're right. In the interest rate environment we've been in, it really hasn't. And there, so good. So So again, another quick obvious one is you never typically would want to buy a tax-free municipal bond in a Roth IRA or even an IRA, because the interest on those bonds are tax-free. So again, we buy those typically in taxable accounts because you're already getting tax-free interest. So that's a big red flag. If a new client comes in and they've got tax-free bonds in an IRA or something, we kind of shake our heads at that. It's like, what was this advisor thinking by doing that? So again, there's some obvious ones. Like you said, typically the Roth, you want the most growth. If you got a tax-free bond, you typically want that in a brokerage account. But asset location can be a big deal. So, and I think I've talked about this on a previous episode of Upticks, though, is that, so just remember though, like if you're a client and you have a Roth IRA, an IRA, and a brokerage, and you have a spouse that has the same, we're not going to invest all of those accounts the same way. Because a lot of times people will say, well, my Roth IRA is doing a lot better than my IRA. Why is that? Or my Roth IRA is doing worse, right? Depending on the market environment. And that's because we're utilizing a strategy called asset location, and we're trying to get the most bang for your buck based on the account type. And so don't think it's not like because again, we're not using mutual funds or products. It's not going to be cookie cutter and every account's going to look the same. No, we're going to be strategic, and we're going to try to get the most benefit from the account type and put the appropriate asset in there. Now, again, we can't predict the future, so we ultimately never really know. But again, if we think a stock has more growth potential, we're going to put that in the Roth probably. And if we think a bond is obviously tax-free, we're going to put that in brokerage, right? And then everywhere in between as far as that goes. Very good. So I want to talk about another topic here. And this third topic here could be a show, and probably is a show out there on Upticks all in of itself. And quick commercial for that. If you haven't already subscribed to Upticks, I would highly encourage you to do that. Cory's got a show called In the Money Insight. They're both available on YouTube and your favorite podcast platform. We are kicking these things out every week, and they're created for our clients. So again, we're just trying to educate our clients and help them ultimately understand what their financial plan means to them. I've been excited, Cory. We've had a nice uptick. Look at that. I'm using my name in the show. We've had a nice uptick in subscribers here lately, particularly on our YouTube channel. So that's always fun to see that continue to grow and people to add. Okay, so for this third strategy, NUA is what I wanted to talk about, and it's called Net Unrealized Appreciation, or NUA. This is a complex tax strategy which will require taking a distribution of your company stock from your 401k and not rolling it over, but putting it in a brokerage. Cory, do you want to comment on NUA a little bit? I know we've done this quite a bit for many clients.
Yeah, I just think talking about it conceptually and why it could make sense for clients and situations. The whole idea is that taking advantage of net unrealized appreciation in an appropriate situation, it allows someone to pay capital gains on highly appreciated company stock as opposed to ordinary income tax, which oftentimes is higher.
Right. Good. That's a good direct answer. So the takeaway for this subject is if you work at a publicly traded company and you have publicly traded stock in your 401k, certainly you need to talk to us before you retire or separate from that company, or before you sell that stock, because again, there can be some favorable tax treatments if we utilize this net unrealized appreciation strategy. So it's a good one. It's a big one. A lot of accountants, believe it or not, don't even know about it, which scares me a little bit. But again, it's something that we've done for many years for many clients, and we're happy to walk you through it if you fall in that category. Okay, good. The other one I want to talk about is the Roth, right? You kind of already heard me allude to it, but many clients, whether they're earlier in their career, later in their career, or even retired, are now exploring more of the Roth IRA. And you've heard me to define it, but Cory, do you have any thoughts on the Roth IRA?
Yeah, I think the Roth IRA is a great tool for people to use. I don't, the same way though, the same concept would apply here though, in that I wouldn't recommend typically that a client have everything in a Roth or everything in a pre-tax or everything in a brokerage account. But because of the tax advantaged, tax-free growth inside of a Roth IRA, there's a lot of situations where it makes sense for a lot of people.
Right. And many, I think, again, accountants get this wrong, because you got to remember, your accountant is typically looking at your tax situation in that 1 year. So a lot of accountants will say defer, 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 do pre-tax, do pre-tax. And that bothers me, because if you have $2 million in a pre-tax 401k that we roll over to an IRA, when you're 72, you're gonna have to pull out around $80,000 if it's $2 million bucks. And so the point is, if you had some of that in a Roth, you wouldn't have to pull out as much in your 70s. And so I think a Roth IRA, it's never too early or too late to talk about it. It's something that needs to be discussed literally every year. And actually, if you already have $2 million in an IRA, pre-tax IRA, it's not too late to potentially convert some of that IRA to a Roth. So again, it's an ongoing conversation. Roth IRAs, though, again, you pay taxes up front. That's why I think accountants somewhat ignore them a little bit, because it doesn't influence the tax situation in that first year. But as financial planners, wealth advisors, we're looking out your next 20, 30, hopefully 40, 50 years, however, right? And so we want to make sure that you, over your lifetime, lower your taxes, not just in 2022. So we're looking at, your 30-year tax liability. How do we make that as low as possible? And a Roth IRA is one way to potentially do that in a big way. And so don't ignore the Roth. I don't care who you are. I don't care how old you are. I don't care how much money you have. It's something that should be discussed every year, like you said, Cory. And another side note on that, we've purchased financial planning software, tax planning software, to do just that. So we review our clients' tax returns every year, and then we can determine if a Roth IRA makes sense or not. So quick caution to clients: don't call me up and say, hey, I saw this episode on Upticks, should I do a Roth? Like, I'm not going to be able to give you advice that easily. What I'm going to do is direct you to our financial planners, Matthew, Joe, or Jake. I'm going to say, hey guys, will you take a look at, Mr. and Mrs. client's tax situation, and then let them comment on if a Roth makes sense or not. And they can go over the pros and cons of how it influences your tax return in any given year. Again, we're not tax advisors, but we can do some of these projections, and we can make some observations from a tax planning perspective.
Yeah, just as a quick side note on that, I have found, Jake, that being proactive in the short and long-term tax planning for clients, and then also keeping their accountants or their CPAs in the loop of what we are thinking and what we're looking at, how we're evaluating the situation, I have found that to be very productive for everyone involved, for us, for the accountant, and for the client.
Right. It's a good point, Cory. I'll get two more for you in here that I want to bring up on ways to lower your taxes. And the first one here is look at your charitable giving. The itemized standard deduction is quite a bit higher now. So many people that donate to charities are no longer eligible to write off those deductions. But if you utilize something called a donor advised fund, that's where it's a separate account. You can think of it like an IRA or Roth. It's just a different type of account. But you could front load that. So you could put $40,000 in there to get you over the standard deduction and not be forced to give all that to a charity in any given year. So if you give, $2,000 to your church every year, and let's say you got a big bonus, or you have some stocks that have appreciated or whatever in your portfolio, you can put 40 grand in there potentially, and potentially write off that or whatever's over the standard deduction, right? And again, you want to check this with your tax accountant. But this is a way to lower your tax bill this year, and then ultimately set up a planned giving approach for future years. So again, donor advised funds are a big thing that we do at Falcon Wealth Advisors as well. Another way to lower your taxes. And if you're already giving to charity, you should, so that, again, this applies to anybody that gives to any 501c3 charity. If you're doing that, we should have a conversation about if a donor advised fund makes sense for you or not. Cory, you have comments on that?
That's really good. What I like about the donor advised fund, though, is that not only can you contribute cash, but you can contribute appreciated stock.
Right.
So it's not only a way to get the tax deduction associated with the gift to the donor advised fund, but also a way to potentially avoid capital gains on appreciated stock.
Yeah, very good. Very good. I actually thought of another one. I'm gonna let you talk about it. Why don't you bring up health savings accounts? It's another way to potentially lower your taxes.
Yes, health savings accounts or HSAs. I think that they belong in the financial planning discussion along with 401ks and IRAs and Roth IRAs. The ability to put money in a health savings account that you're going to take distributions from in the future to pay for healthcare related expenses. The HSAs offer in some ways the best of both worlds in that you can get a tax deduction for the money that you put in. It grows tax deferred the same way that an IRA does. But the distributions are tax-free, like a Roth IRA, if the money's used for qualified medical expenses.
Right. So to be eligible for HSA, again, you got to be in a high deductible plan. So not everybody's eligible.
Right.
If you're currently working, it's an easy question to your HR department. And if you are eligible, we should have a conversation about it because, again, that is another way to, again, potentially lower your taxes. And again, some people put money in an HSA, Cory, and then they turn around and use it. I don't think that's, in my opinion, the best way to leverage that account. I would use an HSA, put money in it and invest it and let that grow for later in life. Because the idea is, like you said, the money grows tax deferred. And if you pull it out and use it for qualified medical expenses, it'll actually be tax free. So I wouldn't use it. It just, some clients will come in like, oh yeah, I put money in there, but then I took it out. Well, that's not really, that's not the worst thing you could do, but
right.
I think there's a better way to leverage that account. So if you're eligible, let's talk about it. All right, very good. And then my last topic I want to bring, especially in a year like this year, is to take a look at tax loss harvesting. So again, this wouldn't apply to your IRA or your Roth IRA. It'd only be if you had money in a taxable brokerage account. And the way this works is if you have a stock that's down, you could potentially sell it and take a loss against other gains and lower your tax liability. But Cory, do you want to elaborate on tax loss harvesting a little bit?
Yeah, you just described it at a high level really well. Realizing losses to offset gains, understanding both short-term versus long-term and how those two offset each other inside of a taxable account. But yes, I think the strategy makes a lot of sense, especially in a year like this one. But I do want to point out so people know that we're not investing with the intent of selling our investments at a loss, but there can be situations where it makes sense to do this. But I would not recommend typically someone realize a lot of losses for the sake of offsetting gains if they're going to put themselves in a situation where they may miss the upside of having that money invested. In other words, I wouldn't want to spend $1 to save 30 cents, if that makes sense, on taxes. I'd rather make money.
Right. So again, yeah, you got to be strategic about it because again, if you sell a stock and you realize a loss, you can't turn around and buy that stock the next day. You typically have to sit out on the sidelines for 30 days. And that's what Cory's getting at here is that you could miss a bounce back or rebound, and we would hate to do that. Now you can invest the money in something completely different, which is fine. But again, if we've got you diversified and you sell all of your tech sector because it's down this year, well, if tech turns around and runs up, you miss all of that. And so you got to be careful. So again, this doesn't apply to everybody. And in fact, here in the fourth quarter, we're going to have our investment management group start taking a look at clients and probably proactively, or they they will be reaching out proactively to certain clients where they think there's an opportunity. But if you're a client of Falcon Wealth Advisors and you want us to take a look at it, don't hesitate, reach out and we'll talk about it. We'll take a look at your account. But we are going to start going down the list here and looking for opportunities to maybe lower some of that tax burden. Particularly, some of our clients have large capital gains this year for whatever reason. Maybe they were forced to sell a stock because it got bought out by another company, or we rebalanced and we made money, or we've trimmed or whatnot. So again, there may be some gains that just happened that we need to look at offsetting. But again, you got to be very careful because this is a secondary strategy. Like Cory pointed out, we ultimately want to make money. We're not really looking to buy something just to help your tax situation, to lose money and help your taxes. That's not a good investment strategy to go and do that. So.
Yep. No, that's really good though, because I do think it is. And again, gains are good, right? It means that
yes, it's okay. Yeah.
We want to be clear on that. Gains are good. But I also think that to your point, and really just speaking to the whole concept of the show today, Jake, back to what you talked about earlier about asset location. This is one thing I've ran into with clients that I just want to bring up real quick, is that if clients own mutual funds inside of a taxable account, mutual funds oftentimes will distribute capital gains annually. And I've certainly ran into it with clients before that have owned funds in taxable accounts. They've owed capital gains on the mutual funds they own, despite the fact that their accounts were down in that calendar year.
Yeah, good call. So you gotta be careful about that. Yeah, again, we're not big fans of mutual funds here at Falcon Wealth Advisors. Not only do they have hidden fees and then the advisors charging a fee, you're right. You may have a very unpleasant tax year and not necessarily plan on that, right? Because again, they usually will notify you, but again, a lot of people don't do anything, right? And they get surprised by it's like, why did I have to pay all these taxes? And the mutual fund's down. That's what Cory's talking about. So again, good news is we don't really dabble in those. I don't like them. They're expensive, and again, you don't have the control because they're realizing the taxes, not our clients. So.
Yep.
Good. Well, thank you again, Cory, for joining me on the show. I know we've got to wrap up here. Is there any other kind of parting words you have as far as ways to lower taxes?
Be proactive and talk with your advisor. Make sure that they're doing proactive tax planning for you. This is the time of year to do it, not in March.
Right. Yeah. Don't call us. And frankly, don't call us on December 31. More than likely, it's going to be too late to do anything. So let's do it now in October and November, early December. Because sometimes it requires opening another account, transferring, right? There's a lot that goes into it. So you can't just rush and do this at the end of the year. Be proactive, right? As one of our business coaches says, is be the adult and let's get this done so that we can improve your tax situation. But just know our team at Falcon Wealth Advisors, we're going to be proactive. We'll be reaching out to do more tax planning with a set of our clients. If you have any questions, you can reach out to us and we'll certainly be here for it. But if we've got a bad year in the market, but we can help lower your tax bill, maybe that'll offset, again, some of the pain that's been incurred as far as the market volatility this year. Thank you again, Cory, for joining me. Thank you all for tuning in. As always, please like and share our content, and we hope you have a great week.
All right.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.